The UK exited the European Union on January the 1st, more than 4 years after the country voted to leave the economic bloc in a 2016 referendum. Britain's exit from the EU has come at a very challenging time for the country's economy. Not only are businesses adapting to a raft of new rules from the trade deal, but they are also enduring the third national lockdown in England as the surge in COVID-19 cases refuses to slow. Britain's economy is expected to contract by about 11% in 2020 because of the effects of the pandemic, with the recovery in the first half of this year set to be very muted. Despite all this gloom, the benchmark FTSE 100 index secured its best start to a year on record. So does post-Brexit Britain present a lucrative opportunity for investors right now? Welcome to Pocketful of Dirhams. I'm Alice Hayne from The National, and joining me today is Stéphane Monnier, Chief Investment Officer at the Swiss bank Lombard Odier, who will guide us through the investment opportunities post-Brexit Britain presents right now. Thank you for joining me, Stéphane.
Thank you very much.
Now, there was a huge sigh of relief when Britain finally agreed a zero tariff trade deal with the EU on Christmas Eve. And while it meant the country was exiting with a deal rather than it was a thin deal, it was a far better option than no deal at all. So what type of trade deal did Britain actually end up with? Is it enough for the economy to start off on a positive note?
So first, we avoided the worst outcome related to a no-deal Brexit. However, the deal is limited because it has been focusing mainly on goods, which represent only 20% of the UK GDP. The disruption on the UK economy will be contained for the next few months. Basically, the UK avoided trading on WTO terms. This would have made the UK trade with the EU as a simple third party on all goods. For example, it could have been the case that some tariff would have been imposed as per the WTO rules. For autos, it is between 5 and 10% tariff that would have been implemented. So we avoided that. If we had been into the WTO rules, we would have expected that the UK economy would have been losing 10% of its GDP compared to its potential for the next 10 years. At the opposite, with the deal that we have, we think that the UK economy will only lose 5% of its GDP potential had it stayed in the European Union. So that's the big difference, and we have avoided the worst outcome.
And with that in mind, you're still saying that the UK is going to lose some of its GDP as a result of leaving the European Union. But what's the outlook for the UK from here? We have a fall in GDP last year of 11%, and it's not looking particularly great for this year either, thanks to the rising number of COVID cases. So do you think the economy can still rebound?
So the short answer is yes. The reason is that, the COVID-19 crisis is hopefully a temporary phenomenon. And the UK economy will rebound from it, especially, if the vaccination campaign that is currently in place in the UK is successful. So that's possible that the UK economy will rebound quite strongly, because this is one of the world economy that has suffered the most damage from an economic point of view in 2020. So the rebound will be very big. And the vaccination campaign seems to be going well in the UK. And the UK is one of the few countries that have approved 3 vaccines, the Pfizer vaccine, the Moderna vaccine, and the AstraZeneca vaccine. The last vaccine is a game changer because it's easier to produce, it's easier to deliver and store. What is very important in this context is the vaccination of the vulnerable people, the population over 65, and also the healthcare workers. As soon as those populations will be vaccinated, the hospitalization rate and the death rate will decrease sharply, hence the need of confinement will be much less in the UK. And this will happen much before herd immunity is reached. What we call herd immunity is when 60 to 70% of the people are basically contaminated. On this side, I would say that you can also compare the vaccination campaign in the UK with the United Arab Emirates, which is also doing a great job when it comes to vaccination, with more than 10% of its population currently vaccinated.
Yes, I mean, vaccination is very important and we are seeing progress in both countries. But what do you think will have the bigger impact on the economy in the long term in the UK? Do you think it's going to be Brexit or the pandemic?
Definitely Brexit. The Brexit will have negative consequence for the long term, let's say over the next 10 years. It will be eroding the UK competitive advantage. We believe that the country can overcome this by, I would say, reinventing itself and being innovative, but it's not a given. On the other side, if I'm talking about the pandemic has a violent short-term impact, but with the fiscal and monetary support, the economy should be able to go over the sanitary crisis, in the course of 2021, and probably we would expect that in 2022, the GDP level of the UK will have caught up on its level in 2019.
So it's more of a short-term issue. But in terms of the trade deal and Brexit, I mean, there's still a lot of negotiations to come, aren't there? I mean, they've resolved some of the issues, but there's still more to come.
I will correct you a little bit on this. I don't think there will be more negotiation because the trade deal is over. It is done. There may be some forum discussing its implementation in more detail, but the deal is now done.
It is done, but it doesn't cover everything, does it? It doesn't cover financial services, for example, and those discussions are going to start again soon.
That's correct. It's done as far as trading goods is concerned, but not services. And I just want to remind you that services represent 80% of the UK GDP. So from there, I think there are a lot of areas that demand further talks to continue smooth economic relations between the EU and the UK. If you take Switzerland as an example, there has been a discussion for the last 5 decades between the EU and Switzerland. And you can expect that as far as services is concerned, it's likely that the UK and the EU will find themselves also in constant negotiation. More specifically, the two sides will need to agree on subjects ranging from moving employees from one location to the other, on travel, on tax, on police cooperation, on insurance policies. It's very important also to remember that the UK has been benefiting over the last decades about a high level of foreign direct investment into the UK, but this might change going forward, because a lot of the services that are provided from the UK to the European Union may not be possible in the future.
So one of the things that does need to be ironed out is the issue of equivalence in financial services, and that's the arrangement that governs cross-border financial services. So what do you think we can expect there then? Because we've already seen that 7,000 financial services jobs were lost because of Brexit, and about 6 billion in European share trading left the city in the first day of trading of the new year. So, I mean, why is equivalence so important?
The equivalence is important because it covers different areas of services. So the two sides need to agree on the way the asset management industry, for example, is going to function going forward. They need to agree on where European securities or UK securities can settle, in which clearing houses. So there's a full range of financial services that account for close to 7% of the UK economy and probably 3% of the job of the UK economy that need to be defined and agreed between the EU and United Kingdom. For the time being, I would say there's been some temporary equivalence in order to avoid disrupting the functioning of the financial services in the short term that have been granted until June 2022. But going forward, all these things are in the balance, and they will need to be negotiated between the EU and the UK as far as financial services are concerned. And as you rightly mentioned, there are a lot of economic implications of that because the interest may not be totally aligned. Clearly, there's been a lot of talks about making the UK a financial center such as Singapore. There have been reference to Singapore on Thames. And if you take another point of view, if you were German, probably you would want to have all those services being operated more in Frankfurt on Main as opposed to Singapore on Thames, because the kind of politician interest will be to preserve jobs or gain job in their own country.
So do you think the City of London can remain a leading financial hub going forward?
Well, I think that's not going to help. It is clear that the UK gained the status of a major financial hub, especially after the Big Bang in 1986. Progressively, the UK financial sector gained prominence in the world. Now it all depends on the negotiation of those equivalents with the European Union. It is clear that this is not favoring the UK position. And you have, other financial center like New York, who's already having a higher share in many aspects, maybe with the exception of FX markets, than London. But you would also have in the future emerging financial centers like maybe Shanghai going forward.
So it's all going to change. And how does all of this compare to Switzerland? You mentioned Switzerland early on, and they lost their equivalent status when the European Commission let its recognition of Swiss stock markets expire in 2019. So as a Swiss bank yourself, how do the two situations compare?
I would say the situation of Switzerland is slightly different in the sense that Switzerland is having a land border with the European Union. It's actually surrounded by 4 countries that are part of the European Union: France, Germany, Austria, and Italy. The other difference is that Switzerland has less restriction as far as people moving around the border. Just to remind you, Switzerland is part of the Schengen Agreement, which the UK was not. So now that the UK has executed on its Brexit, it is fair to say that Switzerland is closer to the European Union than the UK. And despite that, as you rightly pointed out, in 2019, Switzerland lost its equivalent status when the European Commission let its recognition of Swiss stock market expire. So, if you take that example, you could imagine that the same sort of things could happen easily in the UK going forward.
So with all of this doom and gloom for the UK, I mean, what's the outlook for investors, people outside the country that want to invest back into the UK? I mean, what's the outlook for them?
Well, I think the outlook as far as the financial place is concerned is that probably the UK will have to try to find agreement with also other parts of the world. Maybe it can help, being a financial center for countries outside the European Union. I'm thinking about some emerging markets, such as, the Middle East, but also Russia, maybe Latin America. Basically, what we need to have is the UK reinvent its position in the world with relying less on its economic relationship with the European Union, unless it's able to negotiate a very positive agreement on financial service. But this looks to me complicated to do, because basically, if you summarize Brexit, is the UK has decided to put the emphasis on its sovereignty, its ability to make its own decision at the expense of, I would say, having easier service exchange with the European Union. And unless it goes back to that decision, it will be very difficult for the UK to have a lot of facilities to operate financial services within the European Union.
Now, Rishi Sunak would disagree with you. He says that, we shouldn't look at the sort of what's happened in the past. We should look forward and consider new opportunities. But I mean, obviously, he's doing this against a very poor economic outlook at the moment. We have rising COVID cases in the UK, and the government's also had to issue more emergency support for businesses to help them survive through the third lockdown in England. So is the UK really a good investment opportunity at the moment?
Well, the one characteristic of financial markets is that they anticipate things. So I would say, if you look at the FTSE 100 as a representative of UK stock market, this is one of the market that has lagged all the other European market, because a lot of institutional investors or even private investors did not dare to invest in UK equities while the outcome of the Brexit referendum was not very clear. And you probably noticed that, and you said in your introduction, that the UK market had a very good start of the year. So this is part of the catching back to reality and on the relative good news of a Brexit deal as opposed to a no deal Brexit. Going forward, I would say the UK equity market structure has some advantage in the sense where a lot of the cyclical sectors, such as energy, such as financials, such as industrials, are represented. And this is probably good in a context where you expect the vaccine to win the race against the virus, and when you would have a strong cyclical recovery that we expect, to come in the middle of 2021. So being positioned in UK equities is probably a good idea, and ourselves in our asset allocation, we are currently overweighting UK equities.
So is that more of a short-term opportunity at the moment, or do you think that's a long-term opportunity?
I would say it's an opportunity probably for the next 12 to 18 months. Very difficult to say beyond that. So probably not such a great opportunities for the very long run.
And what about IPOs? I mean, this week, British bookmaker Dr. Martens became the third company to talk about floating on the London Stock Exchange. Do you think there'll be a surge in premium listings this year, something that the UK government is actually targeting?
I don't think so. I think that the UK, for the time being, is losing its ability to pitch those investments, to a wider audience, and especially to, investors originated from the European Union. So I would not be surprised if some of these IPOs of smaller companies would actually, going forward, happen for the European Union in their domestic market. Let's say in Frankfurt for German small companies, in Paris for small French companies, in Madrid for small Spanish companies, and so on.
Okay, so lots of change there, people referring back to their own countries. And what about currency markets? I mean, the UK pound has been pretty low for some time now. What's the outlook there going forward?
Well, I think that the British pound had a reasonably good performance after the announcement of the deal on Brexit. I think this might have a little bit further to go. The potential that we see on cable, sterling versus US dollar, is something like 140. And we definitely think that the deal has put a floor at 130 on cable.
So it's got a sort of more of an optimistic outlook.
Correct. Moderately optimistic.
Okay. Well, keeping in mind with that optimism, one bright spark in all of this has been the UK's property market, which has actually been acting in reverse to the rest of the economy. We've had house prices surging upwards since the start of the pandemic. Do you think that trend is actually sustainable?
I think it's very difficult to talk about real estate market in general because you will have to differentiate first between the residential market and the commercial real estate market. And you have some major trends in both happening. If I start with the residential market, I think there was a huge discrepancy historically between the prime market in the center of London and the rest of the country in the UK. And I would not be surprised that, over the next 10 years, there is some sort of rebalancing because I would say the center of London could lose some of its attraction, partly due to Brexit, but not necessarily only. And the rest of the country could gain in terms of attraction. As far as the commercial real estate is concerned, some sectors will be very much affected by the COVID-19 crisis and Brexit. You could imagine that the office market in London would suffer from it. I think, some damage will be done to the hotel industry, to some leisure industry. And conversely, I would say some sector like logistics could benefit, especially, I guess logistic around the port of Dover is going to become pretty crucial and pretty strategic going forward.
So to wrap up, Stéphane, what three things should investors wanting to target the UK look for now?
I would say the first thing to target is interest rate. We believe interest rate will stay low for longer to support the economy. So investing into fixed income assets is probably not such a bad idea in the UK. The second element, which I would like to mention, is volatility. If one of the outcome of the Brexit crisis, if I take an opinion more broadly than the UK, is that it has reinforced the European Union. When the British people voted for Brexit, the initial worry was probably that some others will maybe follow suit and start to do their own exit of the European Union, Italexit, Frexit, you name it. Actually, thanks to Mr. Barnier's roles in the negotiation, the European Union has been very united in those negotiations with the British. And now even the most populist politician in the European Union don't talk about leaving the Union. On the contrary, I would say for the UK, there is a risk that the Brexit will put the British Union at risk. As you know, there will be election in Scotland in May this year, and Nicola Sturgeon is likely to win those elections and bring back to the fore the subject about Scottish independence. One of the other consequences of Brexit is that we did not reinstate a physical barrier between Northern Ireland and Southern Ireland. And it could be the case that also in the future, this question also come back to the fore. So there is potentially seeds to question the British Union going forward, which are elements that will probably create volatility in the financial markets, and so focus on volatility. And last is one point that we mentioned, UK equities. In the short run, we see opportunities. The country was among the first to approve COVID-19 vaccine and is one of the most advanced in rolling out its mass vaccination campaign. Hence, I think that the UK market, which remains one of the world's cheapest, presents some good opportunities for investors.
Plenty for them to think about right now. Thank you very much for joining me today, Stéphane.
Thank you very much.
Thank you this week to Stéphane Monnier. If you would like advice on your personal finance issues, you can write to me on pf@thenational.ae. And remember that PF stands for Personal Finance. Please do subscribe to the podcast in your podcasting app to receive weekly updates and leave us a review so we know what you think. This episode was produced by Arthur Ellison. I've been your host, Alice Hay.